The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. This is our regular Investors Observer members only workshop. Welcome to all of you who are here. All right, this is our agenda for today. It's pretty much the standard agenda. We'll look at some charts, we'll talk about what else is happening, look at sectors, industries that are hot right now. Some member-driven content is the rest of it. I think, just one question ahead of time. But that's fine. That just leaves more questions for those of you who are hearing me right now. You can ask questions now. Just put them in the chat box there, or if you have a question as I'm talking, you can type it in there as well. All right. So with that, let us get to the charts. Things look a little different since the last time we talked. Last time we talked was somewhere in this area. It looked like things were coming back, and now we've got this going back down again here. One thing that's kind of interesting is that this, I've seen people calling this kind of a head and shoulders. What's weird about the head and shoulders is a head and shoulders is usually a sort of bearish reversal. So something goes from, sort of an uptrend to a downtrend. And we had a big break in the uptrend here. And this isn't high enough to match up with this to be your sort of classic head and shoulder, where this would be the head. So I'm not necessarily saying this isn't some kind of reversal, but I don't see the head and shoulders that some people are talking about in the S&P. One thing I did want to do is I stretched it out to the last 3 years with weekly candles. This one is 1 year with daily candles. And on the 3-year, you can see we still have held on to quite a bit of that post-pandemic recovery. In terms of where were we the last time the stocks were priced like this, it was, the third quarter of last year. Right, certainly some things are lower. We'll look at some of those in a second, but, overall, it's not terrible. All right, the NASDAQ certainly looks different. One, in terms of just being down further from the peak, which you'll note was earlier than it was on the S&P. And while we did get this sort of rise, fall, we got, nothing here looks at all like a head and shoulders on the NASDAQ. Things have been generally sort of uglier there. So that is, that's kind of what that looks like. And on the 3-year, it also, right, it went up more and it's come back down more. It's still well above the pre-pandemic high. We're back to like the second quarter of last year as opposed to the third quarter or fourth quarter, but there's no it's not, the losses are big. Certainly they're bigger in certain stocks, but it's not, really a catastrophe. I think we're really sort of just entering the sort of correction, 10% down from the high level at the on the S&P. The NASDAQ obviously hit that a little while ago. The Russell 2000 is much more interesting. So we had this sort of fake breakout late last year, and then found some support at a higher level than we sort of had in the previous range, and then it really dropped off a cliff to start the year. But look at the NASDAQ. The NASDAQ is setting new lows for the year, whereas the Russell is not. I'm not smart enough to get a lot of big meaning out of that, other than to say that it seems like an index of 2,000 small caps is doing less badly than an index of 100 very large, mostly tech companies. And then, the 3-year on the Russell is more interesting. We're probably a little bit closer to the post-pandemic high here, because, we just spent all of last year going sideways with the Russell. kind of interesting. But you know, the Russell also had one of the sharpest rises from, you know, sort of the time vaccines were announced in late 2020. You know, it had that big run, and then, you know, kind of moved along. And the Russell also has more stocks in the S&P 500 and the NASDAQ, so you get a little bit more diversification, and some things are up and some things are down, and so the index goes sideways as opposed to going up and down quite as much. All right, the 500 versus the 500 equal weight. You can see here for the last year, we're now at a point where the equal weight, which is the red and green line, is slightly outperforming the broader S&P 5 or the cap weighted S&P 500. And what that means essentially is that if we want to call them the S&P 495, which is right, the S&P 500 without the big five at the top: Apple, Google, Microsoft, Amazon, Netflix is probably the other one. Yeah, we're not quite as yeah, those five have lost a little bit more than the you know, some of the other ones. And so that's, you know, it's always kind of interesting, because during the pandemic, I don't have a 3-year chart of this, but during the pandemic, you know, your Apples and your Microsofts represented some quality. People bought those and sold some other stocks, whereas now, you know, those have given back a little bit more. All right, growth versus value. We continue to see value sort of outperform here. We've talked about it, you know, earlier this year, and this has gotten sort of more pronounced. And you can see, you know, even with the more recent downturn, growth has lost significantly more than the value has. Just, you know, the line is just steeper in terms of how far it's going down and how fast. And that's, again, a sign of, you know, people getting out of a lot of tech stocks and other speculative stuff. I didn't put charts together for it, but I, you know, a lot of the stuff that was hot sort of in early 2020, in 2020, and then, you know, early 2021, a lot of the SPACs, and some other stuff like that has really, you know, some of that stuff is way down. And then Tesla is another big player in the growth indices, and that has lost ground as well. So Bruce is asking, VUG is the growth fund, VTV, which is what I'm comparing it to here, is the value fund. So VUG is the red and green on this chart, and VTV is the blue. VUG is growth, VTV is value. All right, so I don't really have a lot of intelligent things to say about Russia, Ukraine. Right, that's not really my area. I will point out that the last time, you know, Russia invaded Ukraine with the annexation of Crimea back in 2014. Yeah, this chart is just gas prices in Europe. Gas prices were high. Russia's a big gas station, basically. You know, they export a few other commodities. They're big in nickel. I think they have some aluminum. But it's really oil and gas is where they, you know, what most of their economy is run on, and how the country kind of funds itself, is exporting oil and gas. And so, yeah, Brent is the sort of offshore European oil contract, and it's less about the level here than it is about it just being high. So here we have high oil prices back in 2014. This fall off, and, you know, this fall off was the fracking boom. We had the pandemic here when everybody stopped driving, and now that it's coming back, it gives Russia some power again, because, right, you can hurt Russia's economy, but with a tight oil market, that ends up hurting everybody else's economy as well. If you say, yeah, we're not going to take that oil and gas, that kind of hurts everybody else. And so, the only other chart I have related to this is, all right, so This is vehicle miles traveled in the United States. So the first thing that jumps out here is there's a ton of seasonality in vehicle miles traveled. Yeah, don't let anyone tell you that summer driving season isn't a thing, because it obviously is. But what I really wanted to point out here was this bit, right? Like, why have gas prices and oil prices gotten so high? Right, so the sort of pandemic level, everybody stopped driving. Like, this goes back to sort of levels not seen since the mid 90s. There are a lot more Americans and a lot more cars than there were then. So for this number to go this low is pretty incredible. And then even the peak last year didn't get, this one in 2020. I keep forgetting 2021 exists for some reason. But yeah, even the peak in 2020 was a level not seen since the Great Recession, or sometime in the late 90s before that. And then last year, it did recover, right? Driving seems to be back relatively on pace. But it's a lot easier for me to go outside and start my car and start driving it than it is for somebody to turn on, off, and then turn back on an oil well. And so driving rebounded just a lot faster than oil production could keep up, and that is why gas prices are so high. And that is what gives Russia the power to sort of do some things right now that would have been, it just wouldn't have worked several years ago, because with the United States producing a lot more oil and oil prices being lower, there's room to really crack down without crunching the economies of Europe and the United States. All right, so what else is going on? The Federal Reserve, outside of, obviously headline panics about Russia, Ukraine, the Federal Reserve, interest rates, inflation are still the big drivers of stocks. The Russia-Ukraine thing obviously plays a part here, but the direct effects from Ukraine are hard to calculate. Any recent increase in oil and gas or other prices that's getting blamed on this Russia-Ukraine conflict is about panic. It's right. Nobody has actually shut anything down yet in that regard. So that's just a panic and people telling you a story. Russia and Ukraine are both pretty big commodity producers. Ukraine produces a lot of wheat and some things like that. In addition to, Russia also is a pretty big wheat producer, in addition to the things I talked about a minute ago. So yeah, prolonged conflict and sanctions could lead to some higher commodity prices there, which ends up kind of looking like more inflation, but it's not. Right, that's not a thing that higher interest rates are going to help. Right, and again, right, the data about inflation is going to continue to be noisy for a while. This just kind of adds to that noise, right? There's COVID seems to be waning, but is still affecting things. There's droughts in some grain producing regions of the United States and other parts of the world. Right, we have the shipping crisis. All those things just make getting a clean reading on kind of inflation data very difficult. And inflation also isn't just a U.S. story. It's also running hot in Europe and some Asian economies. And so the Fed really isn't going to be able to fix all of that. It just kind of is a thing where we have got, right, that chart we looked at in terms of driving bouncing back much faster than oil production could bounce back is the same thing we have going on in a whole bunch of places in the economy. And it's just those things need to kind of normalize a little bit, and then it kind of evens out. Earnings season is kind of wrapping up. Most of the big companies have reported. Generally things are pretty good. We've seen some compression of margins due to higher costs, but also a lot of companies that feel like they can pass on higher prices are raising prices and not seeing much effect on demand. It was interesting. Home Depot reported yesterday, and then Lowe's reported today. Home Depot reported, sort of some shrinking margins and blamed, commodity prices and inflation. And Lowe's did not report shrinking margins. So that A lot of what you're seeing is really about sort of execution and what companies think they can get away with. And my guess is either, yeah, it seems unlikely that Lowe's is able to jawbone suppliers into not raising prices, and Home Depot wasn't. It seems more likely that Lowe's is just able to pass on more of those cost increases to consumers. I mean, we see a lot fewer companies sort of issuing that forward guidance at least, several years out, which is not surprising, really. It was always a little bit speculative to try to issue guidance 2 years ahead, which some companies were doing. And in the environment we've been in for the last, honestly, probably 5 or 6 years, it seems even less, reasonable or useful of an estimate. So, yeah. If you hit it, good job. If you miss it, it's right, or have to adjust it downwards, it's bad. So it's better just to not give a number when the risk reward for giving the number is you end up having to lower your guidance and your stock gets whacked, or if you estimated correctly, you don't get any real benefit from that. All right, the sectors that are hot right now, energy remains at the top. Coal, which we've talked about before, coal is a relatively small piece of this, or, it's got a bunch of relatively small companies in that sector. It's a little bit weird that it has done so well, but oil and gas have remained strong. Utilities has climbed up the list, and that's a sign to me of investors being nervous. It can also be a little bit of an interest rate thing, but to me, utilities are where investors go when they're nervous about other things, because everybody knows that if you got to put your bills in order, the electric bill is somewhere near the top in terms of the ones you pay first. Car payments, credit cards, things like that may get prioritized differently, but everybody wants the heat to be on. So utilities tend to rise when people get nervous. Real estate's another kind of interesting one, especially with the home builders not doing well. But yeah, residential, industrial, and retail REITs, I don't think that should be any surprise. A lot of that's about, it's really three different stories. Residential, I think we all know about. Housing prices, rents are also increasing. People are trying to move sort of generally with, work from home and different situations like that. People are rethinking where they live and what their priorities are. The industrial REITs is a lot of stuff like storage and warehouse space, which goes back to supply chains. And retail REITs got really beaten up when nobody was going out, and now that things are starting to reopen, they're coming back some. Financial services is pretty much always has been on this list forever. What's on here seems to change, but regional banks is another interesting one, right? Like the interesting thing we have going on in the economy right now is that, right, the stock market looks a little ugly some days, today being among them. There's a lot of geopolitical things going on. But inflation ultimately is a story about the economy being a little bit too good. And so banks and things like that, right? Like if you think about a bank as a place where they collect a fee every time somebody takes out a loan or things like that, right? Like there's a lot of things in a growing economy where banks end up doing well, right? Like new business formation, stuff like that. All that is good for banks, especially the regional banks. That's where small businesses go to get money most of the time, more than, Wells Fargo or something. Financial data and stock exchanges is another one. Volatility tends to be good for those kind of businesses, right? Yeah, that just makes sense. And then yeah, the diversified banks, those are your Wells Fargo and other things. Those also do well in a growing economy. There were several corporate bond issues. Twitter selling $1 billion worth of bonds was announced today. All that stuff does well for the big Wall Street kind of banks that underwrite like $1 billion bond offering. And then finally, industrials, and these are, yeah, it's all supply chain, right? Marine shipping, rental and leasing, integrated freight and logistics. That's the supply chain, and things seem like they're starting to get a little bit better there. The number of ships waiting to unload seems to be going down. Stuff like that. You still see long lead times on some things occasionally. But that that sort of does seem to be clearing up at least a little bit. All right, as I mentioned earlier, we only really got one question ahead of time, so if you have other questions, we're almost ready for that. So this question came from Kim. She said, I have a rather large portfolio, almost all in stocks. I would like to know what to do to protect it as best I can from a market downturn. The talking heads all say that one is coming. And for the record, this question came in like Tuesday, maybe Monday. In any case, it didn't come in like 2 weeks ago. It came in fairly recently. So we were already well off the highs in the market. And so the first thing I would say is, right, like the talking heads you see on television are on television because producers think they'll say something interesting, and it's some combination of producers think they'll say something interesting and they picked up the phone. Right? Like if you're going to go on TV and say stocks tend to go up over time, but there are periods of volatility that are hard to predict, that's not a thing that's going to get you on TV because it's not interesting. Right? The TV bookers don't call you to say that. The other thing is some of those people on TV, I watch a lot of financial television. Some of those people have been pretty steadily bearish since 2008, at least in terms of what they say on TV. I'm pretty sure that nobody who's managing money professionally has actually been positioned for a bear market since 2008, right? I mean, look at how much stocks have gone up since then. You would have gone broke 3 or 4 times trying to be short the market this whole time since 2008. So people who say that are either not in the market or they're actually long and just on TV saying things because I guess they like being on TV. I don't know. I don't really understand what the motivation is there. All this is to say that, right, like talking heads are fine and entertaining, but not necessarily right. And a bunch of people on TV saying that something is going to happen doesn't mean it's going to happen. The other thing I'll say is, right, you don't buy insurance when you think you're going to need it, right? You just have insurance all the time because you don't know when you need it. That's what makes it insurance. And so, right, like, oh no, right? I mean, oh no, I think my house is going to catch on fire in the next couple of weeks. I better go buy insurance. That's not how that works, right? So really, it's about having good practice all the time, right? Periodic rebalancing is an important part of portfolio management because no one knows when a crash or conversely a big rally is coming, right? If you take all your money off the table now and we suddenly, snap back to the highs, well, now you missed out. So keeping things in balance all the time is a better practice than trying to get ahead of a crash or trying to get ahead of some rally because you can't predict those things. So yeah, I mean, the thing is, if you have a lot of wealth tied up in stocks and you're worried about it and you can't afford to lose it, take some profits and put it somewhere else. If you have a long time horizon and aren't super worried about daily changes in your account balance, trying to time the market is more likely to be harmful than helpful, right? I mean, like I just said, if you sell it all now and we snap back, right now you missed out on some of the snapback because you sold low and now you're going to buy back high. That's not how you want to do that. All right. That's all I have today. So yeah, questions from the audience is where we're at. While I'm waiting for questions to come in, like all of our workshops, this one's being recorded. Actually, let me show you two things. You can find them. We'll post it somewhere tomorrow and send you an email. You can also find old webinars in the personal finance section of the website. Also, that what sectors are doing well right now is under stocks and then sector and industry. That list is from the short-term technical score, which looks at sort of how stocks have been doing over the last month or so. So you can do that, but if you're more interested in how the sectors and industries stack up according to some of the other scores, that certainly is available as well. You can dig into an industry, if you want to see what's in utilities. Here's the top stocks. Here's the top industries in the utility sector. All right. Let's see here. All right, so I got some version of this question a couple times. Which is basically, would you suggest buying put option contracts as a hedge in a downturn? I mean, that's certainly a thing that can work. Yeah, I mean, the idea of it as a hedge is kind of interesting. I guess in the sense that you're mostly long, that's another trade that you're putting on. So sure, it is a hedge in that way. I think of that more as a short-term trade than some other kind of thing you have. I certainly don't carry an open put position all the time because you just you would just be sort of bleeding to death. Most of the puts would expire worthless and you would take a loss on them. You certainly could. I don't know necessarily that now is the time to do that. I also don't know that it isn't, right? Like I'm not good at predicting the future. Typically, I would think you would probably want to do that at a time when implied volatilities were pretty low and everybody was feeling pretty good about the stock market. Whereas right now, when things we just looked at, where utilities are among the top performing sectors, people are pretty agitated. The VIX is a little high. It's going to be more expensive right now, right? I mean, think about homeowners insurance, right? If you have a beach house and there hasn't been a hurricane for 10 years, you're going to pay a very different rate there than if you have a beach house and there have been hurricanes in the last 3 years. So it's kind of what I would think about in terms of that. I mean, it's now a proper time to add to positions. This is from Bruce. It could be. I mean, I would say it kind of depends on what the positions are, right? Again, like if we go back to the last 2 bullet points on this slide, if you got a lot of money in stocks and you can't afford to lose it, maybe not, because things are a little uncertain. If you have a long time horizon and you aren't worried about daily changes in your account value, trying to time the market is more likely to be harmful than helpful, right? Like my regularly scheduled deposits are still going in. All my dividends are still set to reinvest. I'm not really doing anything special right now. Right, all that stuff just happens. I keep an eye on it. I rebalance periodically. I'm not making any big changes because of the situation. Right, and when I say rebalance, I mean I have allocations that I like to keep at certain percentages in terms of this kind of stocks or that kind of stocks or some bonds. And sometimes one of those gets bigger and one of those gets smaller, and I sell some of the big one and buy some of the small ones, so it comes back into where I want my percentages to be. Would you recommend buying leaps for 2024 and selling calls along the way? I mean, that's again certainly a thing you could do. You know, I mean, most of the time the market goes down, it comes back. So now could be a decent time to do something like that, right? Like leaps for 2024 at the previous high for the S&P level are a lot cheaper than they probably were in October, November when the S&P was actually at those highs. So, if you think things are going to come back, that might not be bad. The thing about buying that leap and then selling calls is, you got to sell an out of the money call that's probably shorter. And so you're either going to be selling a lot of calls and not making very much money because the call is going to be way out of the money, or you're going to sell a call that's actually lower than the call you bought, and then you got to deal with rolling it because if the market comes back really fast and you get caught, now you almost have a bearish position on in that regard, and that's probably not really what you wanted. So Charles says, do you have good strategies for options around earnings considering there's been so much volatility lately? Yeah, I mean, my strategy for options around earnings is don't. I know lots of people like to play that volatility, and that's fine. Right? Markets need two sides. But that is a different strategy than most of what we're doing here. Right? My philosophy and strategy generally is I can't predict the future. Right? I don't know what's going to happen. I don't know what the earnings are going to be. So I'm not going to try. Most of the strategies that we're using here are about selling option premium and then letting that expire, right? Do I know what's going to happen tomorrow? No. Do I know that tomorrow will happen? I mean, frankly, if tomorrow doesn't happen, I'm not super worried about what's going to happen to my portfolio, I guess is the answer to that. But yeah, right, tomorrow is going to happen. So if I sell time value on something that's, maybe a little volatile, but doesn't have some sort of volatility event like an earnings report coming up, that to me feels like a trade that I know more about and can feel better about than trying to make some guesses about earnings. There's a lot of smart people who make a lot of money, right, trading those earnings things. I'm not saying that that's a strategy that doesn't work. It's just not a strategy that I can tell you how to do because, I don't have any special inside information or insight into how that works. All right, so Salvador says, if an investor has some cash on the sidelines during a downtrend, what factors do you consider in deciding when to start nibbling at some quality stocks that have recently been beaten down? I mean, honestly, what I would say, if you see stocks that are attractive to you based on, whatever it is that finds us, you find a stock attractive, now is, right, like what the overall market is doing doesn't matter as much, I don't think, right? Like there are stocks that are hitting new 52-week highs every day, right? Not every stock is down. In a bear market, not every stock is up in a bull market. So if you see stocks that you think are attractive, then yeah, buy them. And don't worry about it, right? Like you're not going to hit the bottom and then hit the top in terms of, buying and selling. It's not going to happen. You may do it once or twice. It's great. It's cool when it happens, but it's not a thing you can base a strategy around. So, if you see things that you think are undervalued that you want to buy, I wouldn't really worry about trying to hit the exact bottom in terms of that, right? Like just buy it and maybe it goes down a little bit more and then it comes back, right? Like, that's okay too. So Bruce says weighing mutual funds over stocks. I mean, a mutual fund is just a basket of stocks, right? That's, I think, to me, a stylistic choice and maybe a choice of, depending on the fund, right? Do you want to pay somebody to pick stocks for you or do you want to pick your own stocks? Right? I mean, a mutual fund that has a bunch of stocks in it versus just owning a bunch of stocks, the mutual fund will probably do a little bit worse, right? Like if you think about, oh, if I went and bought the exact same stocks as this mutual fund, yeah, you're probably gonna do a little worse in the fund because you got to pay the manager. But otherwise, I think it's a stylistic choice. I don't think there's like just put all your money in mutual funds and don't worry about it, and then buy stocks when things come back, because the mutual funds are mostly owning stocks also. Tabor, can you specify? You said prior slide. Can you specify which slide it is you're talking about exactly? Be happy to show any of the slides again. All right, so Brian says, are the top 5 overall stocks rated as strong buys? How would you find an option trade based on strong buy position? So yeah, we're not giving a buy, sell, hold recommendation. Right, all of our scores are percentile ranks. So if you look at, say, the top overall scores, it doesn't seem like exactly the right numbers. Let's see here. Yeah, so we just sort by the overall score. Okay, these are percentile ranks. Okay, so this stock scores better than 92% of stocks for this metric. Okay, and so you are, welcome to do with that information what you will. But right, like the way buy, sell, hold targets typically work is analysts do a lot of work to come up with a price target that's based on what they expect earnings to be and some idea of historical valuation multiples. And from there they come up with a price target, and then really buy, sell, hold is just about the slope of the line, right? Like if the difference between the price today and the price target is going up, well, then that's a buy. If it's going down, that's a sell. If it's going sideways, that's a hold, right? But they're working back from a complex, typically mostly fundamental model that's doing that sort of fundamental analysis, and we include that information in our in our scores, but it isn't exclusively how our scores work, right? So we have well, I picked a stock that doesn't have an analyst recommendation. Let's see, where's one that definitely a cone will. All right, so we have the buy, sell, hold recommendation. This is aggregated, so the Wall Street analysts who cover the stock on average have a hold on this stock, and you can see the mean price target is for a decline of less than 1%. Okay, like that's textbook in terms of what I was just explaining, right? Like the average expectation is not for the stock to really go anywhere over the next 12 months. The average recommendation is hold it. But yeah, in terms of option trades on any of our scores, may have missed our window. Yeah, there's this option trades tab. Here we go. There's this option trades tab for most stocks, and you can see what our options trade for that stock is today. And we have up to 7 strategies. The one that's missing here is the Iron Condor. So all 6 of these plus Iron Condors are potentially available on any stock. The reason we may have some strategies and not others is the math didn't work to make a trade that we found attractive, basically. So Kelly has a question about the target prices. She asked how often they were updated. We get new data every day. We have several different vendors. So there is a little bit of trust there in terms of how often they update it, but I can tell you that we're getting it from roughly the same places as a lot of other big sites, and it all gets updated at roughly the same frequency. And I could do a bunch of Googling and figure out when the most recent target price update was for any given stock, but it's not information I have on hand. And so it's not something I have available to put on the website. Michael says, I have warrants. Can you display them in my portfolio? So Michael, some warrants do get displayed in your portfolio. Some of them don't. That is a weird thing that has to do with how warrants get tagged in both your brokerage account by our external data vendors and also by Plaid, which is the service that links your brokerage account to us. I have another comment about Plaid in a minute, but that's basically how that works. So Brian wants to know, can we define the keys for covered calls? Sure, so we have these keys for all of our strategies. They're a little bit different for each strategy, right? So a 4 versus a 3 here, those aren't directly comparable. They are comparable, so the diagonal spreads, they're pretty comparable across diagonal spreads. The short put and the covered call are relatively the same trade. So you can compare those to each other. The verticals, you can compare those to each other. And what this is doing is it's evaluating the riskiness of the option trade. It is not evaluating, there's no opinion about the potential direction of the stock in the key rating. If you want that, look at the scores, right? The stock scores. What this key rating is looking at is things like, if something went wrong with this trade, how easy would it be to adjust it? So for those of you who know a little bit more about option trades and option trading, if you think about, trying to roll a covered call, if you got $1 for selling an option and the strike width, there are $5 strikes to choose from, that ends up being a hard call to roll a lot of times, right? Just because, right, you're getting $1 and you got to try to manipulate these $5 strike widths. Whereas if you could get $2 and the strikes were $1 apart, that's a lot easier to roll. There's a lot more going on. Also has to do with like how much time, how far away we can find an attractive trade, right? So Apple here, everything is 9 days away. That's pretty short. Whereas if we can't make an option trade work, or we don't find one that has an attractive return until 4 weeks out, that's typically going to have a lower key rating. So those are the things that go into it. And 5 is the highest, 1 is the lowest. But remember, it has to do with how well we think you can play defense on the position should you need to, and nothing to do with the nothing to do with the direction of the stock. All right, so we did have a question earlier about Plaid that I'll go ahead and answer. The question was, is it safe to use the current platform, Plaid, to associate with your respective brokerage account? I have no information that tells me it's not safe. I'm aware that Plaid settled a class action suit relating to data they were collecting. There are, from what I can tell, no indications that any data got away from Plaid. It's just that they were collecting data they didn't necessarily have permission to. And as part of the settlement, they've promise they will, try to fix that. But yeah, I have no indications that Plaid wasn't safe. If we thought it wasn't safe, we would take it down. But I wish it worked a little bit better. I know people with E-Trade and some people like that have had trouble with it. But yeah, those are my frustrations. I don't have any real concerns about safety. I have portfolios linked to Plaid as well. All right, let me go back to the what was hot slide here, since we had a request for that. All right, so Charles said, please explain the time periods for when the option trades are calculated. I see the screener goes down at night and is up in the morning. Why is it down so long? So it's down for so long for two reasons. One is we get a bunch of data overnight and we get it at different times. Another reason is, right, our trades are currently updated once per day. So they're available pretty early most mornings. And I'm not sure that it makes a ton of sense to have a trade that was based on yesterday's closing price available on the website at 6:30 p.m. this afternoon, right? It doesn't seem very useful. It feels potentially harmful if somebody comes to the site, isn't aware that that trade is based on yesterday's closing price and isn't fresh, and then tries to do something with that information. So, we could certainly just refresh things as soon as we recalculate new trades, but it seems to make more sense to take things down when they become outdated and then put things up as soon as we can get them, can get better trades in there. Ralph, we've talked about, adding Bitcoin and other cryptocurrencies to the portfolio tracker. It's on a very long list of things we would like to do. And we have a limited amount of bandwidth for software development, and that one hasn't gotten to the top yet. All I can tell you is it is on the list. All right, so Danny says, I'm looking for bearish call strategies. Look for the lowest possible score I can find in the short term, technical and stock sentiment. Yeah, I mean, that's totally reasonable. If you see something that's going down and you expect it to keep on running, which is basically what that's set up for, yeah, that's a perfectly reasonable strategy. You can kind of play those against each other maybe if you wanted to, right? Like if you want to see, another way to potentially do it would be look for a real low short-term technical and maybe a higher sentiment score. Stocks that are in a downtrend sometimes have up days, so that might be a chance to get something that is a little bit further from the trend in terms of being a little bit safer in that way, right? I mean, you're basically betting that a couple of up days isn't a reversal by doing it that way. But yeah, that's a perfectly reasonable strategy in terms of a thing to do. The thing I would keep in track of is the sentiment score is very short term. So yeah, that's not an indicator I would use for month-long trades. That's more of a days-long trades kind of a thing. But yeah, that's it. Yeah, Tracy asked about ETFs. Yeah, I mean ETFs are available on the website. We can't, trying to find a fundamental score for an ETF is difficult because the ETF doesn't have earnings, right? We'd have to aggregate by market cap the ratings of every stock in the S&P 500 to do that, and that's difficult. So yeah, we don't have some of the scores that we do have ETFs available here. They also show up in the portfolio tracker. We have worked on ways to add a flag for ETFs, so you could exclude or include ETFs in the various screeners. And that's the thing we'll probably get to at some point. I don't have a timetable for it. It's another thing that is a little bit difficult because new stocks and new ETFs pop up every day. And yeah, it's a thing you'd have to either keep track of by hand or find some way to automate, and we just haven't gotten there yet. All right. I think that's all the questions that have been sent in so far. There's a couple minutes left if somebody wants to type one other one in real quick. Yeah, certainly am here for it. But otherwise, yeah, like I said, this is being recorded. We'll send out a recording tomorrow. You can get questions answered anytime through this help button. Just put in your name and email address and a question, and we get back to you usually the same day. We don't answer a lot of these tickets outside of normal business hours. But yeah, we do turn those around pretty quickly. You certainly don't have to wait, 3 weeks to get an answer from me. The next workshop will be, I think it's March the 16th. It's whatever 3 weeks from today is. We'll send those emails out ahead of time. If you have a question that you would like to see me address in some depth during the workshop, send it in and say, hey, talk about this at the workshop. When you get that workshop invitation, you can just respond to that. That's the thing that a lot of people do. And those come to me also. So yeah, thank you all for coming. Thank you for subscribing to Investors Observer. Yeah, I will talk to you later.